In the second module of the section devoted to the statement of cash flows, we begin a two-part inspection of cash flows from operating activities. We will start the module by taking a closer look at precisely which cash inflows and outflows ought to be classified as operating, and then proceed to compute them in a comprehensive example which utilizes the direct approach. In the next module, we will attempt to apply the indirect method to the same scenario. As we already signaled in the previous introductory video, operating activities are defined as the principal revenue-producing activities of the entity and also include all other activities which are not classified as investing or financing. IAS 7 notes that the value of information on cash flows from operating activities is in fact twofold. It provides a critical indicator of the extent to which a company is able to generate cash flows, which should allow it to make investments with the aim of maintaining or even increasing its operating capacity, service its debts, and pay dividends to shareholders. Moreover, information about the components of historical operating cash flows may assist analysts in the process of forecasting future operating cash flows, especially when used in conjunction with other financial statements information. The standard provides the following typical examples of cash flows from operating activities. Cash receipts from the sale of goods and the rendering of services. Cash receipts from royalties, fees, commissions, and other revenue. Cash payments to suppliers for goods and services. Cash payments to employees, and cash payments or refunds of income taxes unless they can be specifically identified with financing or investing activities, as well as specific examples of cash flows which relate to the operations of insurance companies and the holders of some derivatives contracts. As the IAS 7 definition suggests, the operating activities segment also acts as the default category for any cash flows that do not meet the criteria for inclusion under investing or financing cash flows, including asset or business acquisition related expenses, which must be expensed as incurred, as they do not qualify for capitalization in accordance with separate standards such as IAS 16, IAS 38 or IFRS 3. As you already know, cash flows from operating activities may be reported using the direct or indirect methods. Under the direct method, which will be our focus in the remainder of this video, major classes of gross cash receipts and gross cash payments are presented. In fact, IAS 7 encourages preparers of financial statements to apply the direct approach on the grounds that it provides information which is more useful in making projections of future performance than is the case if the indirect method is used. As we will see in an example, information about those major categories of gross cash receipts and payments may be derived either from the cash records of the company or by adjusting items recognized in the income statement, such as sales or cost of goods sold, for the following: changes in the balance of inventories, receivables and payables, other non-cash items, and those items whose cash effect should be included under investing or financing activities. Enough of the theory, let's dive into the example. A company presents the following income statement in respect of the year ended 31st of December 2016, as well as selected items from a balance sheet prepared as at the same date. As you can see, we are presented with a summarized income statement which shows sales, cost of sales, operating expenses, and net income only. We are also provided with balance sheet extracts which show the level of property, plant and equipment, inventory, trade receivables, trade payables, and wages payable. Additionally, the following information is given. Other operating expenses comprise depreciation of property, plant and equipment of €36,000, salaries for the year of €42,000, and a €6,000 gain from the disposal of a fixed asset discussed below. During the year, the company sold one item of property, plant and equipment, which had a carrying amount of €18,000 at the date of disposal. The result on the sale has been offset against other operating expenses. Our task is naturally to calculate the cash flows from operating activities using the direct method. Let's start by attempting to compute the cash inflows from customers. As we have no access to the company's actual cash records, we will need to derive the result by making adjustments to the relevant item from the income statement. In this case, that item is the sales figure, which will need to be adjusted for the change in trade receivables. Let's consider the trade receivables line in the statement of financial position, with its opening and closing balance of €235,000 and €259,000 respectively. Over the course of the year, trade receivables increase as a result of sales made, and we know that the overall size of those sales was €1,200,000. On the other hand, the balance of trade receivables decreases due to the cash payments received from clients. To be perfectly honest, it may also fall for other reasons, such as allowances, write-downs and write-offs, but we are not provided with any information to suggest that this was the case. Accordingly, we conclude that the only way for the trade receivables line to have finished the year with a carrying amount of €259,000 was for the company to have received cash of €1,176,000, a figure which we may plug directly into the computation of cash flows from operating activities. You should appreciate that this result may be explained by taking the number reported in respect of sales, so that's €1,200,000, and adjusting it downwards for the €24,000 of growth in trade receivables. Let us now focus on the cash outflows, which will include two items, namely the cash paid to suppliers and the salaries paid to employees. Computing the first item involves adjusting the reported cost of sales figure for the changes in the inventory and trade payables lines from the statement of financial position. So let's go over the logic of doing this, starting with a reconciliation of the movements in inventory, which began the year 2016 with a balance of €140,000 and finished the year at €160,000. In general, inventory grows due to purchases made and falls when items are either written down or off, or when they leave the company as a result of sales to customers. We are once again not provided with any information to suggest that the former had occurred, so we will focus on the carrying amount of inventory which was handed over to customers, and that is naturally equal to the cost of sales for the year of €840,000. When combined with the information on the opening and closing balance, this leads us to conclude that the amount of inventory purchases which the company must have made during the year amounts to €860,000. This result is obviously not something which we will directly use in the statement of cash flows, but it does get us one step closer to computing the cash paid to suppliers. Let's now turn our attention to the movements in the trade payables line, which opened the year at €138,000 and closed it with a balance of €168,000. Trade payables naturally grow whenever the company makes purchases from its suppliers, and we have just calculated that the total amount of purchases made over the course of 2016 was €860,000. Accordingly, the only way for trade payables to have finished the year with a carrying amount of €168,000 was for the company to have paid its suppliers a total of €830,000. Once again, I want you to appreciate that deriving this result can effectively be achieved by taking the cost of sales of €840,000 and adjusting it by two amounts. Upwards by the €20,000 of growth in inventory, and downwards for the €30,000 increase in trade payables. Applying similar logic to the computation of the cash paid to employees, we take the €42,000 of salary expense as included in the derivation of net income and adjust it for any changes in wages payable. Given the fact that this line remained at a stable €12,000, we conclude that the correct figure to report in the statement of cash flows is an outflow of €42,000, which, when combined with the remaining two entries already made, generates a total net cash inflow from operations which is equal to €304,000. Please note that the remaining items which found their way into the computation of net income for the period were either of a non-cash nature, as would be the case with depreciation, or relate to activities whose cash effect should be presented in the remaining segments of the statement of cash flows. This is clearly true for the cash proceeds from the sale of the fixed asset, which would be included under investing activities.